Ever sold something and felt that gut-wrenching fear? What if they don't pay? Let's face it, dealing with customers who don't pay is one of the most frustrating parts of running a business, but don't worry, accounting has got your back. If you're wondering whether accounting can predict if a customer is going to pay, the answer is simple. No, accounting isn't a crystal ball. However, it can help you prepare for those oh moments by setting up provisions for bad and doubtful debts. Now, let's dive into how this works. Meet Mr. Bean, our customer. You've made a sale of $50,000 to Mr. Bean, a pretty big amount, right? He's expected to pay you back within 1 year. Scenario 1. A year passes, and Mr. Bean only manages to pay $10,000. Due to financial difficulties, he couldn't pay the remaining amount. Now you're sitting in your office thinking, I'm not sure he's going to pay the whole amount. This is what we call a doubtful debt. You're uncertain if the customer will pay the full amount, but there's still a chance he might. This is where a provision for doubtful debts comes in. It's an estimate you make for the amount you think won't be recovered. Want to know more about how to set up a provision for doubtful debts? Drop a comment, and I'll cover it in the next video. Scenario 2. Bad debts no. Let's say Mr. Bean declares bankruptcy. He's unable to pay his creditors, which means you won't be seeing the remaining $40,000. This is what we call bad debt. You'll have to write off the entire amount by debiting your provision if you've set one up and crediting the receivable. If you want to learn more about the accounting treatment of bad and doubtful debts, make sure to check out my next video.